Hello folks, hello again on Castaway Trader YouTube channel. I promised you long ago to record a video with introduction to a modified Elliott waves version of the classic Elliott wave theory. Let's get started. So here you can check my website www.castawaytrader.com and follow me on Twitter for live updates. Okay, so the basic building blocks of any price fractal. The beauty of invention made by Elliott in 20th century was that he recognized that human behavior changes according to some observable, recognizable, and repeatable patterns. And he studied equity markets to confirm his idea. And after he studied that, so he put down some rules which became a foundation of Elliott wave theory. Under Elliott wave theory, the classic version, the main basic pattern, main fractal of a price move is 5-wave move. So here you see wave 1 up, 2 down, wave 3 up, wave 4 down, and wave 5. And the same pattern we can find on the way down. Wave 1 up, 1 down, wave 2 up, wave 3 down, wave 4 up, and wave 5 down. So those waves are called motive waves because they move in the direction of a trend on one larger degree. Under Harmonic Elliott wave theory, however, the main building block of any price fractal is much simpler pattern. A up, B down, C up, on the way up and on the way down, A down, B up, and C down. So let's dive deeper and see how those building blocks make a larger price patterns of so-called larger degree waves. So here we see a typical tape of any stock, futures, or commodity. And if you do know the rules, you just look at that mess and it's very difficult to come up with any idea what's gonna happen next. But if we employ Harmonic Elliott waves rules and guidance, we can navigate that mess and see some hidden order in any tape, in any stock price or commodity price. Let's see how it works. So we try to find the main building block, the main pattern on a very small degree, and we see A up, B down, and C up. And in our book, under Harmonic Elliott wave rules, we call it wave 1, as you can see here, so that fractal A up, B down, and C up comprise waves 1, 3, and 5. Coming back to that mess and see what happens then. So we see that it was first the move up in wave 1, and now we can see a reaction. So when price goes up, there are people who would like to take profit, and they ignite a counter trend move. And that counter trend move is typically shaped as our common building block ABC. A down, B up, C down, and that becomes our red corrective wave ABC. Again, you see our main building block of any price fractal. And this is our wave 2. Then we see that price finds some support. There is enough sellers, who have sold their stocks, and at that level there are new buyers who want to buy it and who push the price higher again. And here we see our A up, B down, C up, again our basic building block, and that ABC up becomes our wave 3. Just notice that top of wave 3 is located much higher than the top of wave 1, so basically price has covered a larger distance in wave 3 than the distance in wave 1. From that point, again, we see that probably all the buyers who wanted to buy have already bought, and here we have enough people who start to sell, pushing the price lower. And it's moving down in our typical ABC pattern again. ABC down, and that becomes wave 4 down, corrective wave 4 down. Here again, ABC up, and that becomes our wave 5. We are coming back to our one of the main building block pattern, 5 waves move up. In the same way as the classic Elliott wave theory, consider that as a viable pattern. The only difference is that under the classic Elliott wave theory, so they believe that that pattern should be observable in every single leg up. So they believe that wave 1 should be made of 5 waves, wave 3 should be made of 5 waves, and wave 5 should be made of 5 waves. And here is the problem. I've been practicing the classical Elliott wave theory for years, and I saw many times how that classic Elliott wave theory failed. What normally happens is that when we get that wave A up of the low, let's imagine there was a major decline of price here and we nailed the bottom, then a typical analyst who practicing the classic Elliott wave theory would say, let's wait first for the first 5 wave move up as a viable sign that the move down has completed. And this is what we normally get. We get that 5 wave move up, and this is how that wave A is structured. Then we say, okay, let's wait for the corrective move, which is wave B, and it should be structured as ABC down. And this is exactly what we normally get. We get ABC down, and then we say, okay, this is wave 1, this is wave 2, and now we should be prepared for the major rally in wave 3. Normally, it never happens. Normally, we get another 5 wave move up, and unfortunately, it doesn't get as high as it would get if it was wave 3. And at that point, a typical classic Elliott wave analyst gets discouraged. He would tell you, you know what? It might be corrective ABC up, and it might be a top of wave 4 up. And we should be prepared for new lows. And from that point, once it starts moving down and we observe ABC down, they keep saying don't buy it here because it's like wave 1 down, 2 up, 3 down, after 4 up, it should make new lows. And it doesn't make new lows here because after corrective ABC down, with a low higher than the low of that major bottom, it starts to rally. It makes A up, B down, C up, making a wave 3. So because we saw ABC up and we counted it as 1, ABC down and we counted it as a 2, we know what to expect next. We know that the wave 3 is coming. And the classical Elliott wave theory practitioner would not be expecting that. At that point, once we get ABC up, they still can think about ABC of a complex correction up. And once again, it starts moving down in a typical ABC pattern of the wave 4 down. We can be looking for a way to short it. While in contrast, it was a great time to start looking for reloading longs again. Okay, let's come back to our typical patterns and the Harmonic Elliott wave theory. So after completed 5 up, which comprise a larger wave A, we normally have a sharp correction shaped as ABC down, and that becomes a larger wave B. this is again our building block, A down, B up, and C down. And such a structure can be observed in corrective waves 2, 4, and wave B. And here we have a completed part of the main building block on a larger degree. We have larger wave A up, larger wave B down, and here it's quite natural to expect a larger wave C up. So let's look at the part of that wave A and B. So here we have motive waves. We call motive waves price moves that move in the same direction as direction of the trend. Here we have motive waves 1, 3, and 5. What is really important to note that when we say that the trend is up, what we mean is that price keeps making higher highs. You see, wave 3 made a higher high than the top of wave 1, and wave 5 made a higher high, higher than both tops of wave 3 and 1. But not only that, look at corrective waves now. So those waves that move in opposite direction to the direction of the trend. So here we have red wave 2, this is a corrective wave shaped as ABC, and we have wave 4 and wave B. They both move in opposite direction to the direction of the trend. And here we also should note that even corrective waves in a trend up would make higher lows than the preceding corrective wave. Indeed, wave 4 bottomed much higher than the bottom of wave 2, and wave B made a higher low if to compare with the start of that structure. Okay, so let's see how that structure completes. First we get ABC up, and this is wave 1, ABC down, this is wave 2, ABC up, this is wave 3, and ABC down, this is wave 4, ABC up, and finally this is wave 5. And as I mentioned before, because we got A up, B down, we knew what to expect next. We knew that wave 5 is coming, and that 5 should be structured as 5 waves up, subwaves up. So this is our wave C up. Again, we came back to the main building block of any price move, A, B, and C. This is the main basic fractal of any price change. And what should be noted, and where basically the main idea of Mr. Elliott is still alive, is that those fractals can be found on any time frame on a chart of any instrument. Look at that. So we've got larger ABC comprising larger wave 1, parenthesis 1, but the same structure can be observed on a lower degree, A up, B down, C up, of a smaller degree wave 1. So basically, when whatever price chart we look at, monthly, weekly, daily, even 1 minute price chart, we will be able to find those patterns. And the patterns, the same fractals observed on 1 minute chart, putting together will comprise a similar patterns on 5 minute, 15 minute chart, and so on. Okay, let's look again at that structure. We should note that larger wave A is made of 5 subwaves, 1, 2, 3, 4, and 5. And larger wave C has a very similar structure and is also made of 5 subwaves, 1, 2, 3, 4, and 5. And larger wave B, a corrective wave B, is made only of 3 subwaves, 1, 2, and 3, A, B, and C. And this is what happens to wave B on any time frame. It will always be made of three subwaves. Together, waves A, B, and C comprise a larger wave, parenthesis 1 up. And again, so we have just seen a microstructure of the basic pattern which can be observed on any market. ABC up, ABC down. Now you can ask yourself a question, so why I need to learn all that nonsense? And the answer is simple: because you can make money on it. Because if you can recognize patterns, then you will be able to predict the next turn of the price. Thank you guys, and follow me on Twitter, Castaway Trader. Check my website, castawaytrader.com, to see the latest updates and counts for gold, silver, mining stocks, and much more. Thank you.